Hello everybody, this is lesson 12 of the lecture International Economics. I will discuss slides 132 to 143 of chapter 2, Major Market Segments and their Assets. In this lesson we will talk about options. What are options? An option is an asset which gives the holder the right, but not the obligation, to buy or sell an underlying asset on a future date at a price agreed on now. The price agreed on now is also called the exercise price, and if the option provides the right to buy the underlying asset, it is called a call option, and if the option provides the right to sell the underlying asset, it is called put option. The counterparty of the option holder is called the writer. He has to do what the holder demands. In other words, the writer of an option has no option, in fact. As a consequence, the risk of an option is asymmetrically distributed. The writer bears a higher risk as the holder. Therefore, the holder has to pay an option premium to the writer in order to compensate the writer for the higher risk. There are basically two types of call and put options: European options and American options. An European option is an option which can be exercised only at a particular date. An American option, to the contrary, is an option which can be exercised at any time up to a particular date. So we can have a European call option and a European put option. Both can only be exercised at a particular date in the future, while an American call option or an American put option can be exercised any time before the particular date. In the following we will discuss only European options. What is the difference, the basic difference between options and futures? From the viewpoint of an option holder, an option confers the right but not the obligation to buy or sell an asset at a particular price. A future, however, implies always the obligation to buy or to sell an asset at a particular price in the future. This difference affects, of course, the market price of an option, as we will see in the following. What is the option value, the market price of the option, at the exercise date to the holder or writer in case of a call option which preserves the right to buy an underlying asset with an exercise price of, let's say, 100 euro if the underlying asset is some kind of stock. We can again use such a diagram to understand how the market value of an option is related to the market value of the underlying asset. At the date of maturity, it is quite simple to determine the price of a call option. If the market value of the underlying asset is lower than the exercise price of 100 euro, it is not profitable to buy the underlying asset at the exercise price of 100. It would be cheaper to buy it simply at the lower market price on the stock market. For the writer, this means that he will suffer no loss from selling the underlying asset at the exercise price. Since he has sold the option for an option premium, he will have a net profit. If the market value of the underlying asset is, however, higher than the exercise price, for example 140 euro, it is profitable for the holder to exercise the option. In this case, the option will have a market value of 40 euro, since you can buy the underlying asset at an exercise price of 100 euro, while the market value of the underlying asset is 40 euro higher. For the writer, this means that he will suffer now a loss from selling the underlying asset at the lower exercise price. In this case, the market value of the writer position in this call option will equal minus 40 euro. We can also express the relationship analyzed with the help of the diagram in form of a mathematical formula. As shown by the diagrams, the market value of a call option to the holder at the exercise date is equal to the difference between the market price of the underlying asset at the exercise date and the exercise price, if the market price is higher than the exercise price. If the market price is, however, lower than the exercise price, then the value of this holding position in this call option will be equal to 0. Of course, the determination of the price of a put option follows the same kind of reasoning. Let's have a look. If the market value of the underlying asset is now higher than the exercise price of 100, it is not profitable to use the put option to sell the underlying asset, because in this case the market value of the underlying asset would provide a higher revenue as using the put option. For the writer, this means that he will now suffer no loss. Since he has sold the option for an option premium, he will again have a net profit in this situation. If, however, the market value of the underlying asset is lower than the exercise price, for example 70 euro, then it is profitable to use the put option, since it is possible to sell the underlying asset with the help of the put option at the price of 100 euro, while the market price of the underlying asset is only 70 euro. So the value, the market value of the option is 30 euro. For the writer, this means now that he will suffer a loss, since he has to buy an asset at the exercise price of 100 euro, while the market price at which he can sell this asset again has only a value of 70 euro. So the writer position in such a put option would then have a market value of minus 30 euro. Again, we can express also the relationship between the price of the underlying asset and the market price of the option with the help of a mathematical formula. Now, the market value of the formula in a put option equals the exercise price minus the market value of the underlying asset if the market value of the underlying asset is smaller than the exercise price, and if the market value of the underlying asset is larger than the exercise price, then the value of the option is 0, since it is not necessary to use the option in this situation. Let's discuss a little bit the standard terminology used in markets to describe the market value of an option. When an option has a positive price, it is said to be in the money. A call option is in the money when the spot price of the underlying asset is above the exercise price, as we have just seen. A put option is in the money when the spot price of the underlying asset is below the exercise price, as just seen. When an option has a 0 price, it is said to be out of the money. The price of a call option before the exercise date is given by the so-called Black and Scholes formula, which looks slightly more complicated than the formula we have just analyzed. The formula was derived mathematically by Fisher-Black and Samuel Scholes. It holds, as we will see, under certain assumptions used to derive this formula. Especially the assumption of a constant standard deviation and of a normal distribution of the stochastic process does not fit perfectly well with empirical observations. But nevertheless, the formula provides a good first insight into the factors that drive the option price. In general, the value of the option, this call option, is the larger, the higher the uncertainty over the development of the underlying asset is. And this uncertainty depends basically on two factors. First, the standard deviation of the stochastical process, which drives the return of the underlying asset. It has a positive impact on the price of the option. Take care that here we have a negative sign, but here we have also a negative sign, so this adds up to a positive sign. And second, this uncertainty depends also on the time span which has to be waited until the option can be exercised. The longer this time span, the larger this expression here, and consequently the larger the market value of the option. So this formula makes sense from an economic point of view. As already mentioned, it does not fit the empirical observations 100%, but it's a workable approximation. In order to derive this formula, a couple of simplifying assumptions have to be made. The basic technique of the mathematical proof relies on a no arbitrage argument, and that is exactly the same type of argument we have used in order to derive the formula for the value of a future before the maturity of this future. Most important simplifying assumptions here are the stochastics of the stock value is log normal with a constant expected return and a constant expected variance. But especially the assumption of a constant variance has proven to be not really realistic. Another assumption is that there are absolutely no transaction costs, taxes, or any indivisibilities, which is of course also not 100% correct from the empirical point of view. Then the assumption is made that markets are efficient in the sense that there are at least no risk-free arbitrage opportunities given. This is the assumption needed to apply the no arbitrage argument technique. Fourth, the assumption has to be made that there is continuous trade in all securities, which is of course also not realistic, since we have typical business hours for all kind of stock markets or derivative markets. And fifth, the risk-free rate of return of the underlying asset is constant. Sixth assumption is all agents can borrow or lend money at the same rate of return. So in reality, different agents have different market standing, therefore they have to pay different rate of returns if they want to borrow or lend money. Especially the assumption of log normal stochastics has proven wrong for many assets because it neglects so-called tail risk at the fringe of the stochastic distributions. Okay, so much for this lecture. In this lecture we talked about options. In the next lecture I will talk about various possibilities for private companies that can be used to protect the international trade deals of companies against exchange rate risk.